Charitable giving is not only a noble act that supports causes you care about, but it can also offer significant tax advantages if done correctly. However, the IRS has specific rules about how much you can deduct, what qualifies as a donation, and how contributions must be documented. Many taxpayers miss out on potential savings, or worse, face penalties, because they misunderstand the rules around charitable contributions. Whether you're giving cash, goods, or appreciated assets, knowing how to navigate the tax implications can maximize both your impact and your financial return. This video outlines the top 10 things you should know about charitable contributions and taxes, helping you make smarter giving decisions before the tax year ends. 1. Only donations to qualified charities are deductible. Not all charitable donations are tax deductible. The IRS only recognizes contributions made to qualified organizations, such as 501(c)(3) nonprofits. Contributions to individuals, political campaigns, or foreign organizations typically do not qualify. You can verify whether an organization is eligible by using the IRS tax-exempt organization search tool. Giving to a friend's GoFundMe or sending money to a family in need, while generous, will not reduce your taxable income under U.S. tax law. It's important to check the status of the organization before making large contributions with the expectation of receiving a deduction. 2. You must itemize to claim charitable deductions. Charitable deductions are not available to taxpayers who take the standard deduction, unless there is a temporary law allowing otherwise, like the CARES Act of 2020. This means that to deduct charitable contributions, you must file Schedule A with your Form 1040 and itemize deductions. If your total itemized deductions, including mortgage interest, state, local taxes, and charitable gifts, are less than the standard deduction, $13,850 for singles and $27,700 for married couples filing jointly in 2024, you won't benefit from writing off donations. Strategic bunching of donations in a single year can help push itemized deductions above the threshold. 3. There are limits to how much you can deduct. The IRS places limits on how much charitable giving you can deduct in a single year. For cash donations to public charities, the limit is typically 60% of your adjusted gross income, AGI. For donations of appreciated assets like stocks, the limit is usually 30% of your AGI. Any amount above these thresholds can be carried forward for up to 5 years. It's crucial to track your donation amounts annually and understand these AGI limitations, especially if you make substantial contributions or use donor-advised funds to front-load donations for future use. 4. Proper documentation is required. The IRS requires written acknowledgement for any donation of $250 or more. The receipt must include the amount, date, and a statement that no goods or services were provided in return. For non-cash donations, you'll need a detailed description of the items given. If the donation exceeds $500 in value, Form 8283 must be filed with your tax return. For high-value items over $5,000, an independent appraisal is also required. Without proper documentation, the IRS may disallow your deduction, even if the donation was real, so always keep organized records and receipts for your contributions. 5. Non-cash donations must be valued fairly. When donating clothing, household goods, vehicles, or other non-cash items, you can only deduct the item's fair market value, what a willing buyer would pay. You can't deduct the original purchase price unless it matches the current value. For example, a suit you bought for $500 5 years ago may only be worth $40 today. Tools like Goodwill's Valuation Guide or IRS Publication 561 can help determine fair values. Misstating the value of donated goods is a common red flag that could trigger an audit or penalty, so be realistic and honest in your reporting. 6. Donating appreciated assets can yield extra tax benefits. One of the most tax-efficient ways to give is by donating appreciated assets, such as stocks, mutual funds, or real estate held for over a year. By gifting the asset directly to a charity, you avoid paying capital gains tax on the appreciation and can deduct the full fair market value, up to 30% of AGI. This strategy is especially effective for high-income individuals or those facing large capital gains. It allows you to make a larger impact at a lower cost while reducing your taxable income significantly. Many donor-advised funds make it easy to facilitate such donations. 7. Volunteer time is not deductible, but out-of-pocket costs are. While you can't deduct the value of your time or services as a volunteer, you can deduct unreimbursed expenses directly related to your volunteering. This includes mileage, at 14 cents per mile, travel expenses, uniforms, or supplies used to serve a qualified charity. Keep detailed records and receipts, and make sure the costs are not reimbursed by the organization. If you travel for a charitable purpose that includes both personal and volunteer activities, only the portion of the expenses directly related to volunteering is deductible. 8. Using a donor-advised fund, DOF, offers flexibility and control. A donor-advised fund allows you to make a charitable contribution, receive an immediate tax deduction, and then recommend grants over time to your favorite charities. This is especially helpful if you experience a windfall year or want to bunch multiple years of giving into one. DAFs simplify record-keeping, allow for anonymous giving, and make it easier to contribute appreciated assets. While you lose some control once the funds are deposited, DAFs remain a powerful tool for tax planning and legacy building. Fidelity Charitable and Schwab Charitable are two of the largest platforms. 9. Qualified Charitable Distributions, QCDs, reduce taxable income for retirees. If you're 70 and a half or older, you can make qualified charitable distributions, QCDs, directly from your IRA to a qualified charity, up to $100,000 per year. These contributions count toward your required minimum distributions, RMDs, but are not included in your taxable income. This makes QCDs one of the most efficient giving strategies for retirees who don't need their RMDs for living expenses. Unlike itemized deductions, QCDs benefit you even if you take the standard deduction. Be sure to instruct your IRA custodian to send the funds directly to the charity, and request a receipt. 10. Charitable giving can be part of an estate or tax strategy. Charitable contributions can play a strategic role in estate planning, helping reduce estate taxes and preserve wealth. Options include charitable remainder trusts, CRTs, charitable lead trusts, CLTs, or naming a charity as a beneficiary of an IRA or life insurance policy. These strategies can provide income for heirs, reduce taxable estate size, and support your philanthropic goals. Additionally, large donations made during your lifetime, especially of appreciated assets, can shift value out of your estate and reduce future capital gains for heirs. Work with an estate planning attorney or tax advisor to explore these options. Charitable giving can be an incredibly effective way to align your values with your financial goals, but only if done strategically. From choosing the right type of asset to donate, to understanding how much you can deduct, to keeping meticulous records, every step matters when it comes to reducing your tax burden. Whether you're a casual giver or a serious philanthropist, knowing these 10 key rules can help you maximize your deductions, minimize your tax bill, and make the greatest possible impact with your contributions. As always, consult with a tax advisor to tailor your giving plan to your specific financial situation and the ever-changing IRS guidelines.